Most investors think the path to wealth is simple. Buy cheap stocks and wait for the price to go up. For decades, this was the backbone of value investing. Buffett himself mastered it. But everything changed when I and Warren Buffett teamed up. I brought a new way of thinking. A way that would transform Buffett's investment strategy and eventually turn Berkshire Hathaway into a global powerhouse. Today, we explore why he stopped buying cheap stocks and how his philosophy can make you a smarter investor. Part 1: Early Career and Buffett Partnership. I wasn't always the legendary investor we know today. He studied mathematics and law, and spent his early career working as a lawyer and later as a real estate investor. In the late 1950s, he met Warren Buffett. Buffett was already a brilliant student of Benjamin Graham. He bought cheap stocks, sometimes called cigar butts, companies with one last puff of value left. Buffett's strategy worked. It was profitable. But Munger noticed something important. Cheap stocks might give small wins, but they rarely grow into something extraordinary. I saw the potential in high-quality businesses. Part 2: Cigar butt investing and its limits. The cigar butt strategy was simple. Find companies that were undervalued. Buy them at rock-bottom prices. Wait for the market to recognize their true worth. It worked in the short term. But I realized it had major flaws. Most cheap companies stayed cheap. Bad management rarely becomes great. The businesses often required constant effort, and I introduced Buffett to the concept of quality over price. He believed investors should 1. Look for companies with strong brands. 2. Seek durable competitive advantages. 3. Invest in honest, capable management. 4. Focus on long-term growth potential. I told Buffett, "Warren, you're too focused on cheap stocks. Why not buy wonderful companies, even if they seem expensive?" At first, Buffett resisted. Paying more went against everything he'd been taught. But I was right. He emphasized patience and compounding. The best money is made by holding quality companies for decades. Cheap stocks might spike briefly, but great companies grow steadily and predictably. Part 3: My philosophy and shift. I introduced Buffett to the concept of quality over price. I believed investors should 1. Look for companies with strong brands. 2. Seek durable competitive advantages. 3. Invest in honest, capable management. 4. Focus on long-term growth potential. He told Buffett, "Warren, you're too focused on cheap stocks. Why not buy wonderful companies, even if they seem expensive?" At first, Buffett resisted. Paying more went against everything he'd been taught. But I was right. He emphasized patience and compounding. The best money is made by holding quality companies for decades. Cheap stocks might spike briefly, but great companies grow steadily and predictably. Part 4: Case Study. See's Candies. In 1972, Berkshire Hathaway purchased See's Candies for $25 million. Buffett was skeptical. It wasn't cheap. The numbers didn't fit his cigar butt model. But Munger insisted. See's had brand loyalty, repeat customers, pricing power, strong management. It was a simple, well-run business with a moat, a long-term advantage. Today, See's Candies has generated billions in profit, proving Munger's approach works. This investment taught Buffett and the world a crucial lesson. Quality compounds wealth far more effectively than cheapness. Part 5: Case Study. Coca-Cola and long-term compounding. Another famous example is Coca-Cola. In the late 1980s, Buffett and Munger bought Coca-Cola stock. It wasn't the cheapest stock on the market, but they saw something else: global brand recognition, loyal customer base, strong management, long-term growth potential. Over decades, this investment has multiplied many times over, showing that great businesses, held long-term, outperform any bargain. Part 6: Key Lessons for Investors. My philosophy is simple but powerful. 1. Buy quality, not just cheap. 2. Invest in businesses you understand. Circle of competence. 3. Avoid mistakes. Don't chase brilliance. 4. Patience is your greatest ally. 5. Let compounding do the heavy lifting. My approach teaches investors to think long-term, ignore market noise, and focus on businesses that can grow sustainably for decades. As I said, the big money is not in the buying or selling, but in the waiting. I stopped buying cheap stocks because he realized lasting wealth comes from quality, not bargains. By studying his philosophy, you can apply the same principles. Focus on long-term growth. Choose excellent businesses. Be patient and disciplined. This is the mindset that made Berkshire Hathaway legendary, and the mindset that can make you a smarter investor today. This will bring me to the end of my class.